and welcome to The Trade. Before we get to the charts that matter, let's have a look at what traders are watching out there. Hamas and Israel reaching a deal for a ceasefire in Gaza that mediators say could take effect on Sunday and include a release of hostages held during the 15 months of bloodshed that devastated the Palestinian enclave and inflamed the Middle East. Oil prices rising more than 2%, supported by a large draw in US stockpiles and potential supply disruptions caused by sanctions on Russia, while, of course, the Gaza ceasefire deal did limit gains somewhat. Canada says it will consider every kind of countermeasure if President-elect Donald Trump goes ahead with a threat to impose a 25% tariff on Canadian imports. This, according to outgoing Prime Minister Justin Trudeau. US consumer prices, meanwhile, increasing by the most in 9 months in December amid higher costs for energy goods, pointing to still elevated inflation. However, we did see the core inflation unexpectedly slow in December. And gold prices extending gains as the dollar dipped after that inflation came in softer than expected, abating inflation pressures and rekindling expectations that the Fed's easing cycle may not be over yet. Jason McIntosh from Motion Trade joined Andrew earlier, expressing optimism on the ASX200 and S&P 500, highlighting potential consolidation phases. He's suggesting maintaining positions, but does underscore the importance of risk management amidst market uncertainties.
And lots of interesting things to get us off with the new year. I think this is shaping up as, well, look, it's an interesting start to the year. ASX200 was up about 7.5% last year, so not exactly what you'd call boom conditions, but a healthy return before dividends nonetheless, clearly an upward trend. This year's starting differently. We have what I'd call some cross currents developing, and I'll go through some charts, explain what I mean by that in a sec, and also go through maybe some strategy for this type of environment, how to manage this evolving price action. Just starting with this chart here at the ASX200. At this stage, the overall structure remains bullish, and this continues to be an upward trend until there's a clear breakdown. But the trend is coming under some pressure. So just unpacking what we have at the right-hand corner of the chart, we've got a steep decline from the December high. That broke below the November low, and what that did, that ended the sequence that we had of rising lows. Now, that in itself doesn't signal a trend change, but it is a sign that the buyers are less enthusiastic about stepping up and buying the dip. Now we've got this rebound. So far, it's struggling a bit to get a foothold. We saw that selling on Friday and Monday. That sell-off, that two-day sell-off erased 5 days of gain. So it's a setting where investors are quick to sell. I think this week's low is firming up as a key level. If the ASX200 falls back below there, then the chart structure weakens further, and then we start looking at the December low. One of the possibilities I'm thinking about is that the ASX200 is in the early stages of establishing a larger trading range between the December high and the December low. Now, if we just remember what happened back in April, so see those blue converging trend lines in the middle of the chart. We had a high in April, prices sold off, had a rebound, but then it was another 2 months before the ASX200 made a new high. Of course, this price action is going to have its own unique style, but I think some sort of similar trading range is a real possibility as we go into the first couple of months of the year. I'll show you why I'm favouring this view. I've got another chart I want to show you. It's of the ASX200 on an equal weight basis. And this is interesting because it's been struggling to get back above its moving averages. Now I've got the 50 and the 100-day moving averages on this chart. And when a market consolidates below its moving averages, you see that blue shaded area at the right-hand side of the chart. When it consolidates below moving averages, what typically happens is it creates a point of vulnerability. Now this doesn't mean that prices will fall, but this is how the structure can start to shift from bullish to bearish. As I say, that may not happen, and this structure isn't present on the ASX200, but I think we should be aware that it exists and monitor how it develops over the next few weeks. I'm working the basis that the overall trend remains up until proven otherwise, but I'm prepared for the uptrend to maybe take a pause, maybe a longer consolidation. I think the way to play this is cautiously. I'm not in a hurry to do a lot of buying at the moment, but That said, I'm also happy to keep holding stocks that remain in uptrends. And as always, giving my profitable stocks plenty of room to move around with the aim of seeing off any further consolidation. And this is an important point, I think, Andrew. I don't want to sell every time the trend comes into question, because if you did that, you'd be selling every couple of months, because there's always a reason to worry. So I want to try and see off consolidations for as long as possible. But then I want to know where my exit levels are should conditions deteriorate.
Okay, so caution is the word that as your approach to the local market. Jason, let's look further afield there. What is transpiring on Wall Street? And look, lots of uncertainty there. I guess we've got a little more clarity just more recently with some with some inflation figures that have buoyed markets, but of course it's all really about Donald Trump and the policy he's going to bring in and expectations, I guess, just more volatility ahead.
Yeah, it's really interesting the price structures that we're seeing develop in the S&P 500 and the US markets generally. So just looking at this chart here of the S&P 500, now it broke down from a coiling pattern on Friday. You can see those blue converging trend lines in the top right-hand corner of the chart. It's that little consolidation pattern for about 3 weeks of consolidation. And so it broke down on Friday. There was some follow-through selling on Monday, but now it's quickly reversed and prices are back around the midpoint of the range. So that's a false break. And I think the rejection of that breakdown shows that the dips are still being bought in the S&P 500 and the path of least resistance remains to the upside. Now, just looking at the structure, the moving average here moving averages remain positive. That's the 50 and the 100-day moving averages. Prices are near the moving averages. The previous times the S&P 500 has been in this position over the last year, so that would be in April, August and September. The prices came back into the moving average region. Buying of the dip has quickly come in, and so far that's happening again now. So I think this is a really interesting part. When we go, I've got another chart I want to show you of the S&P 500, but this time it's on an equal weighted basis. So of course the big stocks have only like 1 part of 500th influence when you look at it on an equal weight basis. Now, when you look at this, the structure changes. This looks more like what we saw in the ASX200 equal weight. Prices are consolidating below the moving averages, and the moving averages are rolling over. So this is one of those cross currents that I was talking about earlier, and I think this opens a window of vulnerability. Now, the big stocks that dominate the S&P 500, they generally still look good. Like Meta, for instance, looks like it's on the verge of making a new all-time high. But it's not a broad-based picture of health. Most stocks in the S&P 500 are currently below their 100-day moving average, which is probably quite surprising to a lot of people when you look at the market cap S&P 500. At this stage, I think, as it stands, the S&P 500 does remain in an upward trend. I think trying to pick tops in markets is a losing game. This has been a resilient trend, and I'd rather give it the benefit of the doubt until it clearly breaks down. But we do have some of those warning flags there. I don't think we should ignore them. For me, this means staying long, dialing down risk a little bit. I want to give the underlying trend the benefit of the doubt, but I'm aware there's some deterioration in the underlying structure and health of the market. I think we just need to take a bit of extra caution. And I'm doing this by using those trailing stops in my profitable positions and being only looking at the strongest setups for new buys at the moment. But look, it is stay long. It's not trying to call a top in the market. It's stay in there, but very much focused on risk management and exiting stocks if and when they break down.
All right, none of us like a warning flag. Jason McIntosh there. That does it for this edition of The Trade. Be sure to join us again tomorrow.